What does it mean to be a business owner when it comes to the type of entity that you are in terms of the tax world? Hi, my name is Robert, and I'm coming to you today from Lenoma Financial Services here, who basically have been involved with taxes for quite a number of years now. In fact, it's only been since 2010 that I've been doing taxes now for the public. So it seems like it's a never-ending process since the world of taxes or the IRS themselves seems to be such a huge conglomerate of things, and it always seems like it's a never-ending process. Sometimes because year to year things do change quite often here. But when it comes to being a business owner and being involved in your day-to-day activities of the business, every single thing that you do or every single decision that you make does have a ramification that can or cannot affect you. And a lot of people tend to not just think about, how does this impact me here, but sometimes they tend to leave it to the wayside and not think about, the ramifications that could occur at the end of the year when you have to file your taxes. So in order for us to kind of go through this sort of rabbit hole of things, there is some scenarios that I want to put together for you here and kind of take you on this tiny little journey here. But when we discuss this with a business owner, sometimes they come out with some legal jargon instead of looking at it from the IRS's perspective. When I ask the question, do you have a business? Oh, yes, I have an LLC, and so on and so on. They're really talking about a legal standpoint when they mention the words LLC as though limited liability company versus, what is the main function in terms of, your tax course here. But just to kind of get an idea of what things are going through here, let's just dive into how things kind of view. Why it seems like it's a never-ending process. Most people don't realize if you look at the entire tax code, it's a huge mural of various things. It's about the code in total is probably about 60,000 pages long. And when we go to reference this, there's technically like two sides to this table. I hate to say it that way, but the truth of the matter is it's kind of two sides to the table. You have the personal side of things, where out of that 60,000 pages or so, about 300 of that is geared towards, the personal portions here. So where do you think the remainder of the stuff is going to be at? Well, it's going to be primarily on the business end of that, the big guy, the big side here. Now, when you think about why or the reasons why, well, the average household could be anywhere between, one to maybe six, or who knows, on the high end, maybe 8 people, versus an organization that could have, number of or massive numbers of individuals, employees, and so on and so on. So you can understand why Congress, who is primarily involved with trying to write the laws for these things, but the IRS are the ones that kind of govern this stuff, is what is it that they're really gearing towards, or who are they really helping out in this sort of situation. So I typically tend to say to the general public that this is really the golden rules that are in effect. It's he who has the gold rules, and pretty much it kind of sums it up with this picture here. Most of the gold is going to be on one side of this equation versus the other. So in the tax world here, the last major change that really took into effect would be in 2017, when Congress got together and kind of rewrote everything here. And the reality is that when you kind of step back and look, well, how did this impact me? You have to say me in what category? Me as the business owner, or me on a personal level? So most people can understand on the personal level how it's kind of touched them. Sometimes on the business level, they tend to not see that whole impact here. But long story kind of short, if we were to kind of summarize, well, yes, I have a business. Well, the IRS is really going to view you in maybe one of these four categories. In fact, most of the time when you start a small business, you are really looking at the section here that reflects as, sole proprietor. And what does that mean when it comes to the IRS, perspective or eyes? Well, I kind of divided this up to kind of help kind of view what's going on here. Sole proprietor, basically how many owners are involved in this thing? Well, generally speaking, it's one owner. And what does it mean, like when you have to go to file? Well, how many times you have to file? Well, you only have to file once in the year. In fact, the way the IRS structures their stuff is, you have the accounting perspective, and then you have which is the beforehand aspect, and then you have the aftermath or the after effect, which is the tax perspective. So you have to look at it as all the transactions that happen from the 1st of January all the way through to the end or the 31st of December if you're on a calendar year. And that closes your set of activities or set of your books. And then the following day, the 1st of January, you have to start preparing to file your taxes. And they give you 4 months to do this typically. It typically falls on the 15th of April, unless that actually falls under a weekend. Then they kind of push it to the following Monday's time frame. So whatever that date tends to be for that particular year. However, when you go to file this, you file using those personal tax return forms, which is a series of forms that they call the 1040 forms. And inside of the 1040 packages, remember the 300 plus pages that we were talking about earlier, inside that 1040 package, there's a form called a Schedule C, which most sole proprietors tend to fill out. Now, what does that mean when it comes to having to pay the tax? Well, with those changes back in 2017, I mean, they tried to kind of rearrange how much taxes essentially the individual will be paying. But long story short, you have this personal income tax that you could essentially pay that gets, capped up to 37% of the money that you essentially make. But as a sole proprietor, you actually might get stuck with having to pay something else called self-employment tax. So when you look at, being a sole proprietor, what's the possibilities of paying, the amount of taxes you can pay? Well, you could pay, high end of up to 52%. So, we can kind of move on to kind of see what's involved here. You have the sole proprietor as one owner, but then the IRS says, you could be a partnership. And a partnership basically represents 2 to maybe 50 different individuals or entities that hold a common relationship or a common ownership here. Now, with this guy, you have to file one type of business tax return on that one side of that photograph I showed you, and then you have to file another one, which is a personal tax return, which is the same 1040 forms that the sole proprietor would essentially file. So when you look at this, the type of tax form that you would use, it's called a 1065 form. And at the end of this thing, the owner or owners would be issued a form called a K1. And that K1 then gets reported over on your personal side. Now, with the changes and stuff, came the ability to take up to a particular type of deduction. This is what they call a pass-through entity, where you don't pay the taxes on that level, on the business level. You pay the taxes on the individual level, the ownership level. And on that ownership level, you can take up to 20% off from this at this point, up until the year 2024, which is the current laws here, that you could possibly take up to a 20% deduction on this thing. Now, partnership is one thing, but then you also have a different structure called an S corporation. Now, when we say S corporation, is basically small corporation. This isn't to offend anybody, but the IRS has this general guidelines that say, listen, if you have anywhere between 1 to maybe 49 employees, you're considered a small business. 49 employees up to 99 employees, you are considered a medium-sized business. And over 100 employees, well, now you're considered a large organization, a large corporation. So it's not to, reference or offend anybody. It's just to reference a particular type of standpoint as to where you're at. So with an S corp, the most you can have is, well, you can have one owner, or you can have up to 100 owners under an S corporation. Again, this type of return requires that a business return be filed, and then the remnants of this would be listed over on the personal return. The business return is an 1120S. That's brilliant for a small corp. 1120S, and it gets issued on a K1 on the remnants. And just like the partnership, the S corp is a flow through as well, where you could take up to an additional 20% or potential of 20% off of that type of structure. And then you have the granddaddy of them all, which is what most people think about when it comes to some type of corporation, whether you're an Inc. or something like that. It doesn't really matter. But corporations, well, how many ownerships? And then when I say corporation, I'm talking like the large guys, the Coca-Colas, the companies that have been around for, hundreds of years, things like that. How many owners are there? Well, the answer to that question is really, it's infinity, because it depends on who has stock, and how many owners are there in the UPS corporation? Who knows? It all depends on how many people have stock, and not only that, but that stock, as time goes on, that stock could be split, and it could be divided. It could be it could be made into various sections. So how many owners are there? I have no idea. It really depends on how much stock has been issued out. However, what about this guy? Well, how many times do you have to file your tax return on this one? Well, here's the interesting thing. Maybe some people don't realize this, but you have to file, if you're a publicly traded company, you have to file 4 times in a year. There's particular forms that have to be sent in, and that's up to 4 times a year. So, the next time you turn around and you listen to maybe the radio or wherever you get your local news from, and you hear that Microsoft reported their quarterly earnings as blah, blah, blah. What they're saying is they filed their return for that time, and they're showing you what they've earned and what they haven't earned based on what's involved. And because of that, you file a particular return. It's 1120 that essentially gets filed at the end of the year here. And, the owners get issued a 1099 dividend in terms of their paperwork. So if you ever receive the 1099 dividend, or you might have maybe investments that you essentially hold, and they issue you some 1099 INT forms, or a dividend form, basically means you're part ownership of that type of thing. So it depends on your stock holdings too. Now this guy is probably the bigger winner of them all. It used to be a higher tax bracket, and that was chopped down to 21% at this point. So if you were to sum this up, Congress really put together a package and really benefited the business side of that equation, and then gave the personal side little trinkles or little sprinkles on top. So that it made it seem like everybody was on a win-win-win sort of situation during that last tax change in 2017. But let's look at something different here. Now, this is not an original thing for us. This is actually taken from a particular study portion here. But I want to reference to you the differences when it comes to the tax world. Something that's called the cash flow quadrant. And when you kind of summarize the cash flow quadrant, and this is not to offend anybody, but this is just to say, where are you in terms of these quadrants, or where is the individual? Now, if you start to look at it this way, boy, the tax world really starts to change up for you quite a bit, and pretty fast. Now, there's no, rhyme or reason. I mean, most people know what an employee is. I'm an employee, everybody else is an employee. Whoever gets a paycheck, they're an employee. But if we go back to that statement of the reference of well, where is an employee in this part? The employee could pay, if you just round these numbers up, again, it was about 37%. I'm just rounding it up to 40%, so you get an idea of what we're talking about. For every dollar you're making, Uncle Sam or the United States, at this point, they want to make sure they get about 40% of your taxes. You got to think of it that way. Wow. Which is interesting. But if we were to shift from one quadrant down to another, one day you just say, you know what, I'm just going to start a small business. Well, that's fine. In fact, the federal government, the government's going to love you because of that. And if you think about it, why are they going to love you? Well, if you were an employee, you were paying 40% in taxes. When you transition from the employee down to this self-employed quadrant, now we're talking about that sole proprietorship that we were referencing earlier. You're talking about the potential of maybe paying, 50+%, just round it up, it's close to 60%. So it would make total sense that the government would love you because you're going to pay more taxes, or Sohan. Now, you see, when you shift from one quadrant to the next, you actually you've opened yourself up to this different risk world, this world where there's the potential to gain more, but at the same time you can lose more. And the sense of security gets lost, but at the same time, this ability to generate becomes massive. And when you do that, the government understands this. They know that there is a possibility that, you're going to be operating differently. So what do? The government becomes like an associate of yours. They give you incentives. You see, the tax world is a series of incentives, and it depends on what side of the equation, or what side of these incentives that you fall on, that you may or may not be able to take certain advantages of. Or, it depends on how the cookie crumbles. So even though you have the potential to pay up to 60% in terms of these taxes, or, they also give you the ability to have different types of deductions, different types of expenses that come along with this, that the employee up here in this quadrant cannot take. So that's a big thing that, you may or may not have known prior to this discussion up until today, that, there's certain deductions that just will apply to you that will not apply to the everyday employee. Where I find most of the confusion in terms of this quadrant is in between these two sections here, between the self-employed and this side of the equation called the business owner. Now, there's a reason why it's listed with a left-hand side and a right-hand side. Okay, and the biggest reason is going to be the word taxes. Now, when you're on the left-hand side, you have no choice. You're going to pay taxes no matter how you look at it. Sometimes you pay it up front. An employee gets their taxes taken out of their paycheck without them having control over that. Self-employed, on the other hand, they're going to wait towards the end of the year and pay those taxes. When you are over on this side of the equation, now the world starts to change for you even again. When you're on the right-hand side, when you are a business owner. Now, the business owner, now we're talking about those businesses that have jobs. They provide jobs for individuals. They are solving the government's problems by providing jobs for the community. So obviously the government's going to love you because you're bringing in more revenue, and because of that you get even more series of incentives. In fact, most business owners, if you go back to that prior slide, remember the quadrants between a sole proprietor who could pay that up to like that 60% portion versus the flow through entities or that corporation that gets capped, you're looking at maybe a 20% tax rate. So there's a huge difference between, this guy down here and this guy down here. And one of the big differences is, as a self-employed person, you are the do-all, end-all, be-all. You are the one thing that generates this whole thing. But as a business owner, you have a series of people, processes, and procedures that are involved, or price that are involved, that generates this for you. And the more you can mimic this, the better it is for you. You could be the one individual that makes the best hamburger in the world, and you can have your best hamburger shack that makes the most juiciest burgers and be that self-employed person. Or you could be an entity like these franchises that are all over the world, like a McDonald's that is in every single country, all 100 and plus, somewhat countries in the world, and operate on a day-to-day basis. There's a big difference between those two guys. So that's what I mean about, moving from one quadrant to the next, that your benefit or your ability to take more in terms of tax advantages increase tremendously. And in the last portion here, if we were to push down to the last of the four quadrants, is what's known as the investor in this case. Now, striking enough, if the employee paid, and I left the rates up here on the side so you can see that, if the employee is paying 40%, the self-employed is paying 60%, those are high things. The business guy pays, the business owners pay about 20%. The reality is an investor has the possibility of paying up to 0% in taxes. That sounds crazy to say out loud, but the truth of the matter is there are laws. Remember that's a huge 60,000 plus pages, but there are laws out there that actually, and I'm not saying not pay taxes ever, but there is a possibility of deferring taxes for a future date, meaning that you don't have to pay today. You don't have to pay tomorrow, but you can pay in the tomorrow of the tomorrows. And that ends up being a possibility of a 0% tax rate that you have to essentially pay. It's amazing. It's tremendous how different each one of these things operate in. So, as the business owner, you should be thinking in terms of the long term, like, okay, if I'm dealing with things today, how is this going to deal with, in the tomorrow of the tomorrows? And the problem I kind of come across is that most individuals, they're like a deer in the headlights, not necessarily, I have a business, but if you were to ask them, remember, the IRS is looking at like 99% of the people as sole proprietors at this point, unless you elect to do something. I go to ask individuals, okay, hey, you here to do your taxes. Oh, you have a business, great. Can you bring me your profit and loss or your PL statements or your balance sheets? And that's when they look at you like a deer in the headlights and they go, well, what is that? Well, when they say that, I take a step back and go, okay, time out. Let's kind of go back to the beginning. And I reference to them almost the same thing I'm referencing now is, listen, if you're a business, there's certain things you need to know at certain points in time. So it doesn't matter if we discuss what is involved here. So when I say the words financial statements, it doesn't matter if we're talking on the personal level, if we're talking on the business level, heck, if we're even talking about the government in terms of their financial statements, it's basically going to be generally almost the same. Now, the formats are going to lay out a little differently, but think about your own personal setting, your personal statement, your personal income statement. Well, you would want to know that, you would want to know, hey, what am I bringing in terms of my income? So these are a series of, like in the accounting world, there are a series of books. In the old days, there were huge books. They used to call them ledgers, that you carry around and you record every single thing line by line by line by line by line in each set of these books, the income book, the expense book, the asset book, the liability book. But when you put these things together, the income and the expenses, that's considered like, another word for that would be the profit and loss or the income statement, however you want to call it, or sometimes these words are interchangeable, like income could be interchanged with revenue. So you want to look at it this way and go, okay, I get that. Make it, think of the word KISS. Keep it simple, Sally, or keep it simple, sweetheart, however you want to call it. Just keep it seriously simple at this point. But I tend to see that most individuals have a problem with, the portion of the balance sheet where there's assets and liabilities. So if we were just to kind of move forward as to what this thing is here, the two reports that are reflected, the profit and loss, the balance sheet, those are two, but there's a third statement here that you would really, really, really want to look at and focus on. In fact, I would say it's probably the most important of them all, which is called the cash flow statement, or the statement of cash flow. So if you were to draw how the cash interacts, like for example, on a personal level, then you can kind of group these things and categorize them in these manners. Now, I hate to say that, there's different classes of things, but when you look at this, hopefully it kind of paints a picture in your mind. It says, a poor cash flow statement could be that the money comes in straight in, and it could be from a job or whatever. It comes in as a payment, and it goes right out the back door because it goes out through your expenses. So you see, yeah, you can make as much money as you want, but at this point, it's really not about how much money you make. It's really about how much money you can keep and you can use. So let's graduate this thought and move and say, you know what? There is this thing called the middle class when it comes to this sort of cash flow environment. And with it, if we're looking, again, you go with the income portion, the income comes in. However, if we look down here, there is this thing with assets and liabilities, and you notice that this huge amount of funding goes right into the liabilities, what's known as debt. It goes into debt, something that you owe. That's a liability, something that you owe. Asset is something that you have, but in this case, the liability goes right into the debt, and it goes out as an expense straight out. So how much money did you keep? Well, in that case, nothing. It happened the same way. So there's a disillusion because you're thinking that everything is good because you have this money coming in, but then all of a sudden it's going out, and then nothing is being saved or used. So it goes out the door. And then there's a third concept here, and this is where, if we were to draw this line as a definitive line here, this is what they call the 1%ers of the world. The 1% that rule, and everybody else is in the 99% category, where there is this rich environment when it comes to this cash or cash flow. And that rich environment is, hey, the assets are generating that revenue coming in, that income coming in, and it just circles around itself, in and out of itself, in and out of itself. So you have these tremendous investors out there. In fact, we house one of them here in Nebraska, who's one of the richest persons in the world. Well, rich in the sense of very modest as to how much they essentially take. It's no more than a certain amount, but rich in the sense that this asset, this circle, this continues to grow and grow and grow, and it just continues to feed itself. So there's a huge difference between these three things, these three statements: income or the profit or loss statement, the balance sheet, and your cash flow statement. So if we were to jump into this general equation where most people have the issues, is understanding what is my assets, what are the liabilities. Well, look, I just, again, let's kiss the topic, keep it seriously simple. Assets to me personally, what I try to explain is it's something that's going to put value into my pocket. It's gonna put like money into my pocket. Whereas on the other side of the equation of this balance sheet, the liabilities, it's going to take money out of my pocket, just like in that flow, that arrow that was going through. And then the difference between these things, asset minus that liability, is going to equal what's left over, this equity. Or if you were talking on a personal level, it's what they call like your net worth, something along those lines. You think about, there's what they categorize as billionaires walking around. Well, billionaires in the sense where their equity has a lot of zeros behind them, or a lot of commas in between. That tend to be the case. Or millionaires, there's so many ways of viewing that. But again, it's not about just how much you're making in this case. It's about how much you're able to keep, and that's where the equity portion kind of comes through. So This is kind of a way you can view these. Now, obviously, there's some arrows here. How do you make an asset go up and go down? Well, there's some arrows here that kind of draw that out for you in this case. How do you make the liabilities go up or go down? So there's something called debits and credits that are involved here. And when I reference debits and credits, what I'm talking about is in the accounting world, there are these various type of accounts. Sometimes, the programs call them chart of accounts, if you want to think of it that way. But again, keep it simple. Like I said, you had the income category. In this case, it's replaced with the word revenue. And how do you make the revenue go up and the revenue go down? Versus the expenses. How do you make the expense go up and the expense go down? Assets, on the other hand, how do they work? Assets go up a certain way and they go down a certain way in terms of the debits and the credits. So in accounting, it's called a T account because there's one side of it and then it impacts another side somewhere along the line. So try to keep those kind of things in mind. Now, most of the time nowadays, it's not needed in this sense because there's software that can help you with doing this double entry accounting. But what is needed is at least the understanding of what is within these accounts. So here's an example. So for example, an asset in a business could be the cash that you have on hand, like in a bank account. See, most businesses only focus and say, "Oh, I have no money. There's nothing in the bank." But that doesn't mean, you stop there. You're thinking one line item in a whole section of a book. So you have to look at, well, what else is out there when it comes to your asset? So it could be, perhaps you're a service company and you've created something called invoices. And you have these invoices that are out there to possibly get paid for. Well, that's called an accounts receivable. So it's not just, that it's accounts receivable is like the potential of that money coming in. And when that money comes in, it goes in as income. If there were any expenses involved with that, that'd be taken out. And then it's left as cash within the bank, an asset. So there's a flow towards how these things would essentially work. However, what about the supplies that are in your business? You could have furniture or equipment that's out there, tools. What if you're a service company, like a lawn mowing service company? Well, those lawnmowers, some of them are about $4,000, $5,000, $6,000 sometimes when you go out and get them. So those are things that have value. And that lawnmower is going to create more value because it's going to, as you're using it to perhaps service a particular lawn or cut a grass or something like that, you're actually creating income in the future. So that's a good way of kind of viewing that in terms of that. Or what if it isn't? What if it's just your vehicle? Well, your vehicle could potentially be an asset. I mean, think of your taxi drivers or your Uber drivers that are out there, or Lyft, or whatever company you're using it for. You're using that vehicle to generate money that will come in, or generate, this value to come in. But on the other side of this balance sheet, you have these liabilities. So what? Again, liabilities is taking money out of my pocket or out of the pocket. So you would have something that you would owe, a payable that you would owe, aka a bill. If you were on the personal side, what are your bills? And you owe those things. So if you owned a home, it would be your mortgage payment, your mortgage bill. Or if you're renting an office, it could be, your office space. You owe that money to somebody in the long run. Or perhaps it's dedicated salaries if you're paying those employees that are out there, and you owe the taxes on those employees. Remember, the government loves you because you're going to pay taxes. So you have to kind of look at them. What is that? Further down on the list here, it says long-term liabilities. Now, look, making it simple, there are certain things called current or short-term liabilities. Anything that's 365 days or less. If you owe something and you're going to pay it back in 365, it's a current or short-term loan, or in this case, short-term liability. But if you owe it and it's longer than this period, then it's a long-term. If it's 366 days or more, it's considered long-term, according to the IRS. So just keep that, generally in mind. There's a threshold when it comes to the days. And like I was saying earlier, I mean, what if you were halfway through the year and you're realizing that, you know what, I might owe taxes at the end of the year? Well, then that's considered a tax payable, something that you're going to have to owe to the IRS eventually. So having that information on hand, boy, that's seriously super key when it comes to knowing what to do when it comes to, the business activities. And then what's left over, well, that's your equity. That's what you've earned. That's what you get to keep in this case. So your owner is going to have that equity. Or maybe the owner has pulled money out that they've invested in the prior. Those are called withdrawals, or whatever the case is. Now, remember those series of big books at the end of the year. Let's say if this was a calendar year kind of business, at the end of the year, December 31st, you turn around and you close those books. In the old days, they used to grab big old hands and just flop over the big book. When you close that book, that very last number that was on the very last line of that entire thing will be the very first line on the brand new book. So the way I view it is I'm very visual, and I picture that as being, that is exactly what's considered the retained earning. What was the last thing from the last year becomes the first thing of the first year. That's a retained earning in that case. And then you get to, you have the dividends that are involved when it comes to the equity. So just keep that in mind. But like I said, if you were to view these, let's go back and say, now, why does this all matter when it comes to the taxes? Well, let's look at this income statement again here. And let's break it down this way. See, the income statement, that's going to depend on the type of structure that you were. If you were that sole proprietor structure, you would be using the income statement or the profit and loss statement, you'd be using that on the Schedule C. But if you were, if you were a partnership, this would show up on a 1065 form. S Corp, this would be on that 1120S, and the C corporations, that'd be on 1120 on page 1 of these things. So if we would just jump into it, I have an example of what they look like for the year 2019. And if you see, there's a header section that's up towards the top, but it, just like we drew in those boxes there, there's an income section, lines 1 through 7. And then there's a part 2, which is lines 8 all the way down, which is the expense part. So keeping it simple, keeping it seriously simple, it helps to kind of view what that is. So every time you are doing something in the business and you go to use the funding for the business, let's say you're going to write a check or something, you want to know, hey, where in my tax return is this going to show up? And if you think that now, or right away, the faster you think about that, the easier it becomes when you go to do your taxes further down in the tax year. So this is a partnership return. And now you see that the forms look a little different to a degree. There's still a header section. But if we go back to that drawing, here's that income section that we were talking about, lines 1 through 8. And then you have the expense section, which in this case is called deductions. Sections 9 through 21 here. So you get an idea, oh, okay, now it kind of makes a little more sense when you view these things. Now, line by line, that's a different story, because that within itself, that could take you a lifetime to kind of go through, but at least you have a generalization as to what they are. This is a copy of that S Corp, the small corp. Again, header up top. And then we have that box again, income section. And again, deduction section. So you could see, there's a little bit of a pattern here. Well, you know what? Thank you, IRS, for laying it out. And then the corporation, same thing. Header up top, income, and then you have your deduction portions there. So a little bit of a pattern. You get an idea how that kind of is, how it starts to flow. What about The balance sheet. Remember, some people go, well, you know what? Why do I care about, what the balance sheet is? Well, if you were a sole proprietor, well, maybe you would want to know. And the thing is, a lot of them don't, because to them, it doesn't matter. And then you're going day by day by day, not really realizing the major impact that whatever it is happening in your business. So you should have a basis for certain things. You should have an understanding of certain things. You might have borrowed so much money and not even realize it, but because you're not tracking it, you have no idea. But when we look at the balance sheet when it comes to the tax return, well, now there's a reason why most don't necessarily track them. So if we go back to that sole proprietorship, well, guess what? There is no balance sheet on the sole proprietorship tax return. That's most of the time why they don't necessarily want to keep track or know what's going on with it. However, when you go to a partnership, it's actually known as the Schedule L. And if you look through the Schedule L, which we have an example of here, you're going to see there are some columns. There are some columns on the left and some columns on the right. Because the way this part works is the IRS wants to know what were your beginning balances January 1st of the year. And compare that to what were your ending balances on the 31st of December of the year. If you are operating as a calendar year. If you're operating as a fiscal year, it depends on whatever your fiscal dates are. But most of the time, like I said, 9 times out of 10, it's a calendar year. So you would use that. So how much money did you have in the bank account at the beginning of the year? How much money did you have in the bank account at the end of the year? And the difference between that is going to show up somehow. That's important. And most people who are in business don't necessarily track that. I don't know, I have X amount. Well, yeah, saying I have X amount doesn't necessarily understand the ramification here. So you need to follow along with why it's there to make sure that it flows right. Because again, this is called the balance sheet. It's just like a scale. There's one side of the equation, there's another side of the equation, and they have to equal out a certain way. This is the copy of the S Corp. Same thing, Schedule L. You have that section there that reflects, and you can see it says assets, and then it has the liability and the shareholders' equity is listed in the section here. But again, you need the starting balances at the beginning of the year and the ending balances. This is found on page 4 of that 1120S. And then if you go to the corporation here, it's found on page 6. Same thing, Schedule L, beginning and ending balances. These things, you just need to keep track of them. Now, I'm telling you this in terms of a generalization of things. Obviously, this is very much more, I guess, involving in a sense, where, every penny to the T has to go somewhere. But I want you to get at least we can get a general impact of how things go when it comes to the transaction, not only just on your books, but how does it reflect when it comes to the tax return. This is how it impacts you in the tax return. So I'm going to use this example of pretending, let's say, it's just an S corporation that's involved here, because at one point in time you were a sole proprietor and you decided, you know what, I want to be taxed at a different rate, and I want to be an S corp. Okay, you've made that election. That's perfectly fine. However, you do have to do a business return, and you're going to have to do a personal return. So we're going to go through this, and remember, there's certain benefits that would play key as to why somebody would do this. They don't want to pay that self-employment tax portion here, so they were trying to save on the taxes. So how does it play key? And not only that, but how does these certain things like certain transactional lines show up when it comes to my financial statements? So it doesn't matter if we're talking about a car that you might have or a truck that you might have, or maybe you use a credit card to fund your business or use it to buy things, or perhaps you decided to go out for a small business loan for some startup capital, or just get some funding going, or like the current one in today's COVID pandemic time frame here in the U.S. They're going using these loans called the PPP, Payroll Protection Program, or SBA type loans. These are considered loans, So when I say the word loans, hopefully you're thinking, oh, this has to go in that book in the balance sheet. So let's use the small business loan as an example. In fact, we have a sponsor here that we want to kind of reflect and represent here. So let's assume we've gone to the organization, a great organization, Nebraska Enterprise Fund, to potentially go for a small loan. Okay, well, the Enterprise Fund, you got to remember, well, let's think about these T accounts for just a quick second here. And how is this going to impact me? They're willing to do this for you, but when they do, what they're going to end up doing is they're going to infuse, or they're going to put cash into your business. And remember, money into your pocket, that's cash into your pocket. That's an asset that you have to record. So you'll record that, we're using this T account. If you're looking at it that way, you're going to increase that asset. But remember, this is a loan that they are giving you. So when they go to give this to you, you also have to record the liability in terms of that loan. And typically, when the Enterprise Fund gives out funding, it's not for just one day. It's not for just 2 months. Generally speaking, they have what they call terms of this loan. And that loan could be maybe 24 months. 36 months, whatever the nature of that loan is. It's a 5-year loan, like a car loan. It could be 60 months. So think of it that way. And that liability would be recorded, or that loan would be recorded as a liability in that T account. But there is nobody in this world, there's nothing in this world that's just going to give you this funding and not try to receive any kind of compensation or payment for it. So even the Enterprise Fund, they will charge what's known as an interest rate for the use, the opportunity cost of the use of this money. So the interest that they would charge you, that would then be an expense. So you want to see what happened by just one transactional line item. Okay, great. Yep, I got approved for the loan, and I'm gonna have to book this loan. So when you go to look at it, if we use the KISS mentality, here we go as a potential drawing for you. Okay, the asset was brought in, the cash was given to you. Okay, you record that cash as an asset, but then you have to record the bill, which is the loan at this point, on the liability side, so that they both balance each other out in this case. And every time you make a payment to this thing, what you're doing is you're reducing this section here, and you're paying a part of the expenses, the percent of that loan in terms of an expense. So you can record that like what would the interest that you paid throughout the year, if it was the year ending at that point, or every time you're making the payment, it tells you, 10% of that went to the principal of the loan, and then the remainder of that went to the interest, and the interest would go up there in that case. If it was a car loan, it would be almost the same thing, where I got to pay that $100 car loan. Okay, well, that $100, maybe 90% of that is all interest, or $90 of that is all interest, and only $10 of that went to the principal to lower that payment. So you have to kind of look at them that way. But with the vehicle, you got one more thing here. You have to make sure that you recorded that vehicle on this side in terms of the asset. So let's keep it with this loan and look at it again under the S Corp's perspective here. Well, how does that reflect? So if this was the only thing that you did all year long, well, that cash at the beginning of the year on that balance sheet, on that S Corp's balance sheet, well, the beginning of the year would be zero. Or whatever date you started the business, it'd be zero at that point. But at the end of the year, you might have gotten that $100 loan. So the $100 would be up here if that was the full balance of the loan. However, the organization said, hey, you need to pay this over the course of 2 years or 5 years. Well, then down here, if you look further down, we have, this line here, line 20, that says, hey, anything that's that's a note that's payable in the long term, it's something that's a long-term loan to you, more than 366 days, right? 366 and up. Well, the beginning balance, $0, but then at the end of the year, $100. So you got a $100 loan, and they put cash up there in the green. You got a $100 loan that you owe the $100 for in the red, and the difference between assets minus the liabilities equals, boom, owner's equity, the blue, the view of this whole thing in terms of that. So that at that point would reflect as you're balanced. You had a zero amount. Now, that guy that's listed on that last line there, that's going to roll up to the very first page of this tax return form. So on the 1120S, you're going to find that on the very top right-hand corner, right over there. It says, what the balance sheet total was in that case, or what the Schedule L result was in that little section there. But what happened with that interest that you were paying throughout the year? If you go further down, remember, we're not talking about income. We're talking about an expense, and that expense, well, there you go. It would be right in that line item. I once had a business owner call me up and say, hey, well, I gave out a loan to somebody, and how come it's not reflected on my taxes? Well, time out. What side of the equation are you? You're the one that gave the loan out, so you're going to carry that as something on your books a certain way. That's a receivable to you. You're going to get that money in the long run. But on their end, if they owed it, it would be looking like this, is what they would say. And it impacts their taxes in this manner, because the red would be taken off of whatever the funding is at that point. So, it depends on how what position of the table you're on when you're talking about these things here. Now, if we just scroll down a little further into this form, at the end of this portion, he says, okay, well, what was the total of the business income, or, in parentheses, the loss? Can you have a loss in the business? Absolutely. Can you have a gain in the business? Absolutely. It's business. Business is business. There's times when it's up and there's times when it's down. It all depends on the day to day. But whatever's in that line on line 21 there in this 1120S, that guy then gets reported over. Remember, we said you're this particular structure is an S corp, right? So that guy is going to get reported over on a K1 form. So here's an example of that K1 form and where that total would reflect in whatever was on that form there. Well, that gets listed in here because this is an entity where they're going to pay the taxes on the personal side. So if it was one owner and it was $100 in terms of that, well, then that $100 is going to reflect in box one. But if it was, let's say, two owners, and it would be at 50%, $50 in there. If it was five owners, it would be $20 in there. It all depends on how many owners are involved, and it gets split between those things. So it's a matter of, hopefully you're getting an idea how this is starting to reflect. So the person, the business owner at this point would take this K1, and then, the K1, even though it's on the business level, it has to travel somewhere. So you're going to take that K1 and you're going to report that again on your personal tax return on those 1040 forms. So it's going to take a hop, skip, and a jump over down into the 1040 forms. Remember, this is what we're focusing on. You did the 1120S and you got issued a K1. So that K1 then has to go somewhere. And where is it going to go? Let's use that example again. So just recap this one. Your business, you're a lawnmower business, you did $200 in a year. Great. Out of that $200, you got $100 in expenses throughout the year. So that's a subtraction. So you have $200 as income minus the $100. Where did that $100 go? It got deposited into your bank account as an asset at the end of the year. That was all you had. You didn't owe any more money in terms of the liabilities. So assets minus the liabilities is going to equal that owner's equity of what goes on the K1. That K1, again, takes a hop, skip, and a jump over to your personal side. And you go to report that on your 1040, your personal 1040. Here's a copy of the current 2019's 1040 form. We're not going to worry about the header stuff up top. We're just going to jump right to this bottom section here, where we look and say, hey, where did that K1 go when it came to your personal taxes where you have to pay? And how does it really benefit me that I have a K1 or I have this, this business in regards? Well, remember, you could take up to a potential maybe like 20% off of this thing. Well, go back in your mind for just a quick second. It was $200 that you generated, and you got $100 that was left over. So that $100 now is going to reflect in this manner. You got line 7 is going to reflect as $100. And then, assuming this was the only thing, throughout the year, you qualified for the particular type of deduction at this point, where you could take up to $20, up to 20% off of that. So the difference between the 100 minus the 20, it's going to leave you with income of $80. That $80. When you look at this whole thing, man, you generated $200 in the year, and out of that, you're only going to pay taxes on $80 worth. Now, obviously, there's more towards this particular personal form than what's left in terms of the I. But like I told you, I mean, if this was all they had left, this person's probably not going to pay anything in taxes. And they're the business owner. So when you look through these things, man, how can I really impact, this sort of thing? When you take this $20 that you saved, you have the possibility as an incentive to take that money and reinvest it in some form or fashion, like back into your business. Remember that cash flow? Take the money that you saved and put it back into the whole mix of things. Because you do this, or because you followed along with this sort of scenario, what you're really doing, even though we took this long journey in terms of this little rabbit hole here, I hope you realized that out of this whole thing, the biggest asset that any business will have will always be the business owner. So what you should do is always continue to try to educate yourself as best as you can so that you could be its greatest asset. That's yourself. I appreciate the time you've given me this afternoon. Thank you very much. Obviously, there's more involved in this, and I hope this was able to just give you a glimpse in terms of your eyes of what the possibilities are when it comes to your entities and how they reflect in the world or the environment of the IRS and the tax world here. Thank you very much. I'll open it up to any questions you may have.
Robert, there is one question from Lynn Kimsey. She said, if you bought a vehicle for the LLC business in 2020, can you claim the entire down payment on the 2021 tax return?
So yeah, anything that's done within the certain year would get claimed within that year. So I guess it's a little bit of a broad question in terms of that. So the entire down payment. So like, for example, how much are we talking about regarding what's involved and where that's going to show up? So for example, if you go back and you look at the asset, well, did you take money from the bank account to make that down payment? And if you did, then the money that you took away from the bank account, if you're like that same structure we were just talking about, the S Corp structure, then in reality, you'd have to reduce the cash at the end of the year by that dollar amount that you took for that down payment. Does that kind of make it a little sense?
And then there's another question in the chat. I'm hoping so. The other one from Dan Doobie had a question on the cash flow quadrant. He said, shouldn't the investors show up to 15% for capital gains? And he said he understood that they can often dodge taxes in a given year, but the other rows show maximums, not minimums.
Yes, yeah. So as an investor, there's quite a bit of number of loopholes that are involved in that kind of stuff. So, it is an open-ended. So yeah, there is capital gains that are involved with things. If you bought stock throughout the year and you sold it right away, you might have the potential for a capital gain because it was a short term. That capital gain could be pretty high compared to a long term. If you held the stock for just a year and a day, So things like that, yeah, that can impact you quite a bit. Sometimes, it depends. Have you ever heard of house flippers? They purchase houses and one day, and then about 90 days later, they turn around and sell that house for a tremendous amount of profit. Well, in that situation, you bought a house, say for $50,000, you invested 20,000 to fix it up, you're 70 into the mix. You turn around and sell the home for 100,000. Well, there's a $30,000 difference between what you sold it for, what you fixed it for, and what you bought it for. That $30,000 is going to be subjected to that short-term capital gain, unless, and that unless is the big part here, unless you do something like roll it into another purchase. So there is something called the 1031 exchange where you can actually stop paying. You can tell Uncle Sam, I'm not going to pay you the taxes on the 30,000 today because I needed to go buy something else that's going to be about the same amount, 100,000 or more.
Okay, and then I have another one in the chat, Robert. It says, as a married couple, is it best to file as a partnership or an LLC or a sole proprietor? I'm thinking this business filings is what they're talking about.
So, okay, married couples, that's an interesting one because you could be married and be in the same business. By the way, a great benefit would actually be hiring your spouse. As weird as it sounds, if you hired your spouse, you might have the potential to offset some of the expenditures that way. So we could probably do another video just on the fact of having married couples involved with business portions. But with partnerships, well, remember that the partnership reflects a 50-50 ownership, or it could be offset. It could be an 80-20 ownership. We have an organization that specializes in something that's once a year, one big time event throughout the month of October. But they have 3 owners, and those 3 owners are divided 80% to an organization that actually is an LLC, 10% to a male, and 10% to a female. That equals 100% of the K1s. The ironic thing is the 10% for the male and female are both going to a husband and wife. So it is up to you, the individual, how you wanted to go about this. If your goal is to try to reduce your taxes as much as possible, well, then remember, try to look at that side of the quadrant of being on the business side, not on the employee side. But if you were to look at the 4 quadrants, the employees, the self-employed, business owner, the investors, sometimes you have to live in multiple worlds. Sometimes you have to just be 2 or 3 of those objects so that you're able to get the benefit of both things. So you never know what's the situation. You actually have to sit down and look at the tax planning overall wise to kind of get an idea of how things are going.
Okay, and let's see if there's any other questions. I think there's one more here. Oh no, that's that one. So are there any more questions for Robert? Robert, that was an excellent presentation. Thank you so much. We really appreciate it.
Well, I appreciate your time. I apologize. We went a couple of minutes over the time frame here, but taxes is not a quick thing anyway.
No, it's not. Well, thank you all so much for joining us. And Robert will be on the 26th, 26th or 7th, and he'll be going through and exploring business insurance and how important it is for you to make sure all your assets are covered. So thank you again for joining us. Thank you to Do Space for allowing us to be able to present. And you guys have a great new year. Thank you so much.
You have a wonderful day. Thank you very much for your time.
Thank you, everybody.